Hello, this is Rich Canlione coming to you from CME Group Trading Floor. Today's segment is this risk squeezing back on an increase in open interest, good or bad? We've seen an increase in open interest in the last several days, probably in the vicinity of about 45 to 50,000 minis. Ordinarily, conventional wisdom would suggest that when we see open interest on an increase in a declining market, as we've had since the high approximately 3%, that usually suggests that when we see that action, that it is longs getting out. However, usually what you get in a scenario like that is you would see a decrease in open interest, which would be an exit of longs, and then an increase in open interest, which would be new shorts getting in. That's not what we're seeing, so it suggests that you actually have particularly value investors looking for breaks to get into the market, especially since we're still in the middle, at the beginning, I should say, actually, of the earnings front. Just some footnotes, if you will. If you take a look at the most recent economic releases, as of late, somewhat positive and somewhat the earnings are somewhat progressive in that you've seen perhaps, you've taken a good look at JP this morning and Wells. Very good, in fact. If you take a look at JP's, 140 versus 102. If you take a look at Wells, you're looking at 88 versus 72. The only thing that stands out with respect that gives you a little bit of a caution flag is what we saw out of the start of the earnings, which everybody considers as a bellwether, is Alcoa. And Alcoa points the finger at China, saying that there's a little bit of slippage there because of the slowdown in China. We've known this for approximately the last 18 months, but obviously equity prices are where they are. Second bullet point, the jobless claims are somewhat suspect. We all got a big charge out of the jobless claims the other day where they were better by approximately 30,000. That was a surprise to everyone, most analysts out there, most traders, portfolio managers. The interesting thing, however, is that a state failed to report. That state happens to be the state of California. State of California has just shy of 40 million people with an unemployment rate of 10.6%. So you do the math. Once that state reports, what is it going to do to that adjustment in that rate? Another bullet point. Some technicals are coming into play in terms of what we've seen when we look at risk on and risk off, particularly the 30-year yields. 30-year yields, the cheapest we've seen was on 9/26, which was 277, which happened to be the 100-day moving average. What we're looking at is most recently is that yesterday we traded down to the 50-day moving average in yield, which was 283. So I would anticipate a little bit of a bounce there because obviously that's got to be regarded as somewhat support level. Let's look at the technicals in the S&Ps, if you will, the cash S&P. The 50-day moving average in the cash S&P, 427, 428 area. The 8-day, which I like to look at, is comes in at 1446. We're under that, of course, and the trade action has been somewhat negative. However, we do have a double bottom in that area, which suggests that the trade that we put on going from last week into this week, which would have been a short call scenario, kind of gives you a caution flag that, number one, you have technicals that have been breached and you're sitting on top of that support. You also have a double bottom there, if you will. 926 we traded in the cash, 1430.53, and just yesterday we traded 1430.64. Now, based on the momentum that we should get from the positive earnings news, we might be well advised to go ahead and take some of those off the trade off the table with respect to the short call spread, and perhaps actually look to go ahead and cover over the weekend, maybe actually gain some equity exposure. Going into next week, this is what you have that might actually add a little bit of steam, buy-side steam to the market, if you will. Next week's earnings, you have Citi, big deal, bellwether stock. You have Schwab. You're looking at on the 16th, you have Goldman, you have Coca-Cola, you have IBM. I don't know that professional traders, day traders, and portfolio managers and the like would like to be short in front of that, even though what you have going on in Europe is still a negative overtone and negative landscape for the market, particularly what you saw with respect to the downgrade in Spain. But when you have the headwind of Europe in front of you and the tailwind of the earnings scenario in the U.S. that's pulling the momentum and making you move forward in terms of price action, I think you got to see what those earnings kind of stand out and what they project. So that's what you have on the table. Trade the moving averages smartly. Rich Canlione from CME Group Trading Floor signing off. Thank you.